Hi, Professor Dave, it's Delaney. I do want to apologize in advance if it looks like I'm looking at a screen a lot. It's because I am. All my information, I wrote a little script out for myself. It was difficult to memorize everything and hit all the points that I wanted to make. So I do have everything outlined for myself, and everything's fully written. So to begin, we wanted to talk about 3 to 5 of the main principles that we found to be important about our certain code of ethics. I chose to do the code of ethics for accounting because I plan on getting an accounting degree in a couple years. So the 3 that I highlighted that I found the most important were integrity, objectivity, and confidentiality. To start, integrity per the code of ethics that I looked at is a professional accountant shall not knowingly be associated with information that is believed to be materially false or misleading or omits or obscures information. So essentially, if the accountant has reason to believe that information is false or misleading, it should be acknowledged. And then it's followed by a statement saying that as long as the accountant is aware of these points and files a modified report of said false and misleading information, then nothing will happen. I find it super interesting, and I like that it acknowledges that if the accountant acknowledges that, hey, there's a mistake, as long as they point that out, file a modified report, then everything's okay. It basically states it's okay to be human. It's fine, just acknowledge that there's something wrong, don't omit it. So I thought that was really interesting. The next one that I highlighted was objectivity. It states that accountants are responsible for having the judgment to pull themselves away from bias if a circumstance or relationship affects how the accountant provides professional judgment. So that would be like dealing with the siblings' books, or maybe dealing with a client who's requesting certain treatment to their books. This would be up to the accountant to decide if, does this go against, my professional better judgment? Is this something that I should be dealing with personally? So I think it's really interesting because it adds emphasis in that all situations can't possibly be written down, and we would have a giant book that would have every situation under the sun. It basically just says that the accountant needs to use their discretion, use their best judgment ahead of time to avoid conflicts of interest or bias. And then the final one that I highlighted was confidentiality. Basically, accountants deal with a variety of clients. You could be a CPA with only, middle-aged women with children that are single, or you could be dealing with billion-dollar companies. People value their information, regardless if you are a single mom or if you are a business, you don't want your information being spread from person to person, much like a lawyer. It's the same thing dealing with accounting. Even though it's numbers and financial information, it can be harmful if it's in the wrong hands. Essentially, sharing financial information is an outlet for competitors to locate weak spots. It's just unnecessary involvement. It's not the accountant's business. It's not their information. It's not their information to share. Personal information is personal information. It's not their right to share private information. Essentially, if accountants aren't trustworthy and they release private records, they'll be out of business. So that's why I thought that confidentiality was super important, because not only does it deal with the accountant themselves and the clients that they reach, it's also for the business. Just maintaining integrity like we talked about before. The rules are important, especially those of confidentiality, integrity, and objectivity, because without them, there would be no employment for accountants. There would be no standard for an accountant's business. It protects both the accountant and the company they work for. Clients trust accountants to truthfully record the flow of money. If accountants were to fudge the books, these people could get in trouble with the IRS when it's time for an audit, and the money the company was supposed to have isn't there. Trusting someone's already difficult. To find someone to truthfully respect your finances is another level to that toughness. Without these principles, we could assume there'd be no accountants. At least there'd be no accountants that I would want to trust my bookkeeping with. As far as the ethical level that the Accounting Code of Ethics has, I would say it's somewhere in between currently attainable and the practical level. Most of the principles require that accountants act in a way that would be correct as laid out in the legal system. Essentially, it just said that, don't act above the law. If the law says no, you say no. Concepts such as confidentiality require that even if an accountant is off the clock or someone who's no longer their client is involved, that they continue to keep information confidential. While I'm sure that there won't be a random accounting emergency on a plane, keeping respect for current and past clients is not limited to the boundaries of the workplace. So while it may not be to the extent of like a doctor, being called for an emergency on a plane or on the side of the road, accountants are still expected to maintain personal information and not share information even if they're outside of the workplace. Just because you're not on the clock doesn't mean that these rules don't apply. One ethical problem would be cooking the books. So it immediately made me think of Skyler White from Breaking Bad and how she works for Ted Beneke and starts cooking his books for him. It's something that he's done previously in previous years, and she ends up continuing that habit. And what she was doing is she was underreporting their profit. So Ted was keeping all of that extra profit that wasn't being reported to the IRS. One day the IRS shows up and is like, hey, we need to perform an audit. Somehow she bypasses that. IRS moves on, which probably wouldn't happen in real life. I feel like they'd probably be a little bit more careful and a little more analytic of the situation. But that could be an issue that would arise. Normally, anybody can cook the books, and if she had just used restraint and thought about the code of ethics, she could have avoided that problem altogether. So I think that's a really big reason why these rules need to be laid out, because there needs to be some sort of distinction. Things that I learned that accountants are self-driven, which I didn't think that there was so much autonomy with it. I said that essentially, sorry, I kind of hit a brain fart. What accountants do in their profession is truly up to their own actions. I didn't realize how influential the accountant or the individual person is behind their job. It talked about a lot in the Code of Ethics about how the accountant feels or what they think a certain situation, how that will affect their job. They can turn down clients, or they can deny actions if they don't think it's necessary, if it doesn't fit, quote unquote, their code of ethics. But if it doesn't align with their personal beliefs, they can use their personal discretion to say no to a client or say no to an action. It sounds kind of naive, but I believed that accounting was more like, if a client's your client, like a lawyer, then you do what they say, but not exactly to the extent that, all right, if someone says, cook my books for me, that I'm going to go ahead and cook their books. I guess I just didn't realize that there was so much autonomy, and I really respect the fact that the Code of Ethics highlights that autonomy. Like, accountants are able to exercise their autonomy. But that's what I learned about the Code of Ethics for accounting, so I hope you enjoyed. Thank you.